There we are.
Here we is.
That's right.
Hey, we were just talking about man flu a little bit earlier while we were waiting to go live, and one of my favorite little posters is where the wife is leaning over the husband in bed and said, "Can I get you anything else? Some soup, maybe some ibuprofen, your balls."
Yeah, give him back his balls.
Because no, not give him back because he's got the sniffles and he's while women get the flu and they still do the dishes and the laundry and they go to work and
actually you can't do that anymore.
Well, you can't go to work anymore.
Yeah, because if I could have, I would have went to pets when I had this originally, where I just sounded bad, but then the flu hit me. So now my issue is I just can't get that stuff out of my head.
Well, you could still go. You would just people would look at you like, what a dick. Why is he here spreading these germs?
That's right.
It's not the Rona, but it's spreading
no,
these
but
germs.
Since the Rona, it's like you can't go to work sick anymore.
Yeah, which is kind of a smart thing.
Yeah, I know.
There's a guy I love at work who would come in and, oh man, I got the flu. I feel like shit. Go home.
Right. Don't give it to everybody.
Get the hell out of here.
Yeah. All right. We've had some
tell me some things.
Major things happen in the market last week. Friday, we had the Silicon Valley Bank collapse to a certain point. One of the issues was, and this is going to happen, could happen to more banks. And what happened was higher interest rates. So what they did is they borrowed low money, right? They did low treasuries back in the day. And then rates are so much higher, people's deposits, they're just having trouble. And a lot of banks could be this way, having these issues. So right. The Fed said they're going to step in and make sure everybody's okay. But one of the biggest problems, if you look at last Thursday for that bank, $42 billion was withdrawn.
Withdrawn?
Yes, thank you.
Wow.
Yeah.
Withdrawn.
Sorry.
You from Texas?
That's right. I'm telling you right now. So that's a lot.
$42 billion is a lot. Now,
yeah, because every I want to say .com, but every tech company had their money there because they were a bank that actually worked with you. But
okay, was this? Someone told me that this was the second largest ag bank as well.
I don't know about that.
Okay, all right.
I only know that the tech companies really like working with them. But then they're also saying that some of these, this bank actually was doing some of these woke things that they were looking over here instead of focusing on what they should have been focusing on.
Yeah.
And there's a phrase people say, go woke, go broke. I don't know if that's true, but that's not my issue. The issue is if you're going to have this much money and you're going to have a lot of people involved with this, tech companies who have millions and billions of dollars, right? You need to make sure that you can cover that if they need it.
Exactly. Ouch.
So that's the biggest thing that's going on. So right now our market's rallying in the bond market because they're saying, okay, the Fed actually was like a child and threw such a tantrum over trying to control rates that they caused these bank failures.
Oh, wow.
So this is the second bank. There was another bank last week that was all it had to do with crypto. That one failed too. So
with crypto.
Yeah. Well, they just shut it down. Yeah. Is actually what they did.
Yeah.
So right now, with this happening, we're about 90 basis points better. The market really that we look at for interest rates isn't giving it to us yet because they're probably going, I don't think it's going to come. It's not going to stay. We're going to see. So I think they're waiting to end of the day to see how much of this stays.
A little bit of volatility, just trying to figure out where the dust settles.
Correct.
Yeah.
And then because you got two major reports this week, Tuesday, consumer price index. That's going to tell us about inflation on the consumer level. And then Wednesday is the producer price index.
What's NFIB?
National Association of Housing Builders.
No fingers in back.
Yeah, exactly.
Okay.
Yeah. So those are the two this week that are the most important. There's other stuff, job, housing starts, permits, and blah, blah, blah.
But the two most important are the first
are Tuesday and Wednesday.
Okay.
Usually they're a couple days apart, but this week they're right next to each other. Don't know why.
Probably because all the shit going on, huh?
I don't know.
Yeah, it's crazy.
And I mean, that's all I have today really to talk about what's going on because there's going to be such huge fallout because of this. We're going to know more by the end of the day, tomorrow and the next day. And then we're going to see how many other banks,
So what would you say to some buyers out there? Don't fret. It's all going to work out.
This is that shoe that we've been waiting to drop. Right. Something that majorly was going to change so that, hey, Feds, you
wake up.
Yeah. They're not going to raise the next time they meet, which is, I think this week, they're not going to actually raise rates this time. They'll probably just keep it where it is because they don't know if they caused this, which they did. And, Because I mean, realistically, both of them cause it.
Can you say that again?
The management of the company and the Fed.
Right.
Because the biggest problem is you're going to have a cash crunch if you're loaning out money, but you have all your money tied up in low T-bills.
Right.
Because you invested heavily, which was good, but you didn't change the course as rates went up. You should have started investing in the higher rated short-term treasuries, not just stayed in the lower ones.
Right. What a way to wake up, man. Oops.
Whoops. So again, we keep telling everybody, if you're going to buy a home, do it now, because rates are going to, with this
rates
and the next couple things, not going to, they're going to drastically improve.
Yeah.
I mean, they were good Friday last week, but not as good as we've had it before.
Right.
Right. We've had FHA in the last year, I won't say year, last 6 months, lower than it is today. And we're going to get back to that.
Cool.
So
I like it a lot.
Yeah. So, and then I had somebody reach out to me about, I guess Cal Haffa is coming out with a program. It's called a share equity program.
Really?
So they have their normal program.
Right.
Now they're going to do that program on steroids where they give you 20% down payment
up front.
The problem is I said shared equity.
Right.
Right. And I'm not talking about,
what share do they want?
They're going to give you 20%. You owe them the 20% back plus 20% of any additional equity that you make over the time of that house.
For life.
Not
for a 6-year period.
Well, just until you pay them off.
Right.
The problem I have with it is they normally on their normal Cal Haffa program, they do simple 1% interest.
Right.
They're going to do market.
They're going to do market rate?
No, market appreciation.
Oh.
So if the average appreciation is 3 to 4%, it's going to be 3 to 4%. But if you look back over the last 6 years, our average is not that.
No,
it's probably like 15%. Mm-hmm. So you're going to be paying 15% each year on that interest that gets added onto your loan. So at what point, if the rule of 72, I think it is, that divide by the interest rate, and that's how long it takes that money to double.
Mm-hmm.
Well, if that's the case, that second's going to double before you pay it off.
Right. So it's going to eat up your equity.
Yeah.
That's crazy.
It's the worst program
on the planet.
Well, the government, state of California is behind it.
Mm-hmm. Of course.
So, they got into IRAs, right? If you don't have an IRA for your company and you don't have a retirement plan for your company and you have over so many employees, you automatically get forced your employees into this IRA program.
Right.
That's state of California. Go, how do we make more money? Now they're coming in doing this. Okay, we're going to give them 20% and then we're going to get the 20% back plus interest. Plus we're going to get 20% of the appreciation of their house. We're so short homes in California. Do you think we're not going to have a 15 to 20% increase in appreciation over the next so many years?
Of course we are.
Right.
Yeah. So the moral of the story is if you use that, refi as soon as you possibly can to get out.
I know. So what they're giving you is, so you're going to get a benefit of 20% down, right?
Yeah. If you have no cash, that's good.
Right. But if you say that you already, but what's wrong with their regular Cal Haffa program, which is 3.5% down?
Is that you?
Yeah, that's me.
Okay.
I didn't say leave me alone. So the 3.5% down or 3% down conventional Cal Haffa that's right now, they loan you the money at 1%, right?
Okay.
Then you can pay that off anytime. Well, the difference is with 20%, you don't have the mortgage insurance. So you save, $100 some there, plus another couple $100 because you're putting down 20%.
Right.
But you're giving up so much more.
Yeah.
I don't want somebody in my house sharing my equity for 20% down.
Right.
And they haven't even finished the program yet. That's kind of what they're working with. And they did a couple of different presentations and wanted to have the, public get back to them and all these loan officer real estate agents. Oh, this is going to be a great program as long as we put it. So let's not forget land trust. Oh, well, that's a ripoff. Land trust where they own the land and you lease it back for 99 years at a time.
Yeah. Trust me, this is yours.
Yeah.
But we get all the equity.
Right. It's so
don't use it then.
I don't like the program myself. I don't even like Cal Haffa because the rates are so expensive.
Mm-hmm.
Go to your family, get some gift money from your family, and then work out a gifting back.
Yeah, whatever you need to do.
You follow me on that one?
Yeah, I do.
Yeah. Because have them loan you the money and not loan you, but technically, you know what I mean? And just go, hey, you know what? Since you're helping me out, I'm going to give you a small portion of my equity, 3%.
When we sell.
When we refinance the first time.
Whatever.
I'm just saying there's so many things you can do. But think about it. If they got 20% down, your house has to appreciate 20% for that to pay off just that second.
That's horrible.
Right.
Yeah, I was just doing the math in my head.
I'm just saying, so you really needed to go up 40% to be able to pay off that second and make sure you have enough equity to get an 80%.
Yeah. No.
Because you got,
don't do it.
Because I want, like I said, one of my clients, do we qualify for this? I'm thinking, thank God you don't, because you make too much money.
You make too much money. And that's the other thing is you have to make very little
And
money.
I understand, like you look at, what's that company around here that helps people where they help them build the house and then they own it and they have some shared equity. You see them all the time, all building the houses and people put in their equity and
Habitat for Humanity.
That's the one. Thank you. That's a great program because they help them build the house. It's on the lot. It's they wouldn't be able to go anywhere else. And there is a shared portion, but that's better. It's kind of a working together.
Right.
This is just a state to me. This is my opinion. Don't, send letters to me, please. Or if you do, just say hi before you have. The issue is going to be, I just think they're taking advantage of low income people because it's going to be low to moderate,
right?
Which means 150 of AMT at the annual median income,
right?
Or average median income in your area, which I just think they're going to take advantage of those people.
And we'll watch it happen. And we'll probably try to counsel as many people as we possibly can. Actually, I think that's good talking points at marketing meetings and for the realtors is to kind of approach with some factual numbers on this new program and convince them that it's not a good thing already.
Well, I mean, if you can't qualify for anything and they're going to give you 20% down to help you qualify, the first one in that price point, how many cash offers are you going to get?
A billion.
Right.
Yeah.
That's the problem. They're doing these programs and getting these people all excited. The one thing about Habitat for Humanity is they help you build the house, and that's how you get in.
Right.
Because they're building that house with you.
Okay.
No, they're not helping you. They're just trying to take advantage of you. And I just don't know in a market, if we had oversaturated amount of homes.
Yeah, you could do it.
It would be okay.
Yeah.
But we don't.
We don't. And well, actually, you're not competitive anyway. Period.
Not against other offers.
No, not against other offers.
Oh, you got to get down payment from the Cal. I mean, don't get me wrong. There's a lot of people go, I do down payment assistance programs. Great.
Yeah.
But in this market, if you had only one offer and it was that, you'd accept it. But if you got 2 or 3 other offers and in that price point from $500,000 down, you're going to have multiple offers now.
Yep.
It's already happening.
I agree.
Right. So just be careful. Remember what's the 5 worst words you can hear from the government?
Trust me, I'm here to
help.
I'm from the government. I'm here to help.
Yeah. Ronald Reagan said that.
Yeah, exactly.
Yeah. Just be careful.
Yeah,
these programs, they sound great, but when you really look at them, they're not there for you.
The importance of working with a realtor you trust and a lender you trust.
Correct. Just be careful.
Yeah.
Yeah. I mean, if you have no other way to get in, fine. But then I don't even know how you're going to get in the house.
Yep.
Yeah. Anyway, that's all I had today.
Well, and I got to run.
Walk. I don't want you to fall down at your age.
Oh my God. I would just fall apart.
You would just break a hip. And it's not the fall that breaks the hip.
It's that sudden stop at the end.
No, it's the muscles trying to stop you that break those bones.
Yeah.
All right. Thanks for listening to
Have
my horrible voice.
No, you sound a lot better.
Yeah. Well,
drink more of that tea.
Yeah. This is the licorice tea.
Oh.
Yeah. This I'm doing everything my doctor's telling me to do to get my voice back.
Cool.
Yeah. Damn
All right.
laryngitis. All right.
Have a great Monday.
Yep. Make it a great day.
Bye, kids.
Bye.